Hello students, welcome to my class. This is Professor Vincent Isaiah and this is the presentation of Chapter 8, Part 1 of the presentation. Chapter 18, Revenue Recognition. Just like the whole course, as we established at the beginning of the semester, we said that this chapter zeroed in on 5 fundamental issues. Number 1, learning accounting rules, or generally accepted accounting principles, or we also call them accounting standards. Number 2, how to apply the rules. Number 3, we've said that the result of the application of the rules results in information in form of financial statements. And number 4, the information is ultimately communicated to internal and external users for decision-making purposes. And number 5, we analyze the information. In other words, we figured out or determine or interpret what the numbers actually mean. So specifically, we are going to discuss these 5 main issues as they relate to revenue recognition. As you know, one of the 3 main financial statements is the income statement. And the income statement essentially shows the profitability or the performance of a company within a period of time. Now, we also, in its simplest form, we said that the income statement consists of revenues, expenses, the difference between net income or net loss. So we are zeroing in on the first component of these 2 components of the income statement. So now, when we talk about revenue recognition, what do we really mean? Another word for recognition in accounting is account for or record. These 3 terms are used interchangeably. So when you recognize something, meaning you are accounting for it or you are recording it in the accounting books. Now, which is different from reporting, because ultimately by the time you are done with recording the transactions, all of them wind up in the financial statements. Now, having said that, let's take a look at Chapter 18, Revenue Recognition. We said that this chapter is divided into 4 sections. Number 1, overview, revenue recognition at point of sale, revenue recognition before delivery, revenue recognition after delivery. So those are the 4 parts of Chapter 18. Now, let's take a look at the first objective of this chapter. We are going to talk about how to apply revenue recognition principle. Before we talk about the application of the principle, we have to talk about the principles first. So, moving along, here we say that revenue recognition is a top fraud risk, and regardless of the accounting rules, whether United States GAAP or IFRS, the risk of errors and inaccuracy in revenue reporting is significant. Now, what are we talking about here? When we talk about top fraud risk, fraud is intentional act to deceive. So it is intentional. Now, so what we are seeing here is some companies engage in fraudulent activity and force the issue and report revenue inconsistent with the accounting rules in order to meet their selfish ends. But at the same time, there are a lot of situations or some situations whereby revenue is inappropriately recognized, not intentionally, perhaps because of the complexity of the business model or the kind of complexity of the entity of the transaction that the company engaged in. So, at the end of the day, it is not unusual at all for companies to revise their income statement or to revise their revenue recognition. We call that restatement. Now, let's take a look at some guidelines for revenue recognition. We said that the revenue recognition principle provides that companies should recognize revenue when it is realized or realizable, and number 2, when it is earned. So let's take a look at those key terms. Realize, what does that mean? Every company, as you know, either provides services or sell goods. or product. So when we talk about realized, that is a situation whereby the service has been provided or the goods has been delivered to the customer, and the customer pay cash or promise to pay at a later date, and that is accounts receivable, as you know. So that is what we mean by when it is realized. Realizable, in contrast, you provide service for a customer, and the customer, instead of paying you cash or promising to pay you in the future, decided to pay you with an automobile. Now, you receive the automobile because it's an asset, but then you have to look for a buyer to sell the automobile. In such circumstances, we say that it is realizable. Now, number two, when it is earned, what does that mean? Meaning the work has been done. Whether you receive cash or not is irrelevant as long as you have already performed the work or delivered the goods. So those are the two components in terms of revenue recognition principle. Now, moving along, we said that there are 4 different types of transactions that normally will result in revenue. The first one is sale of product from inventory. That is very simple, like Walmart. Walmart will sell an inventory that results in sales. Then, of course, what is the timing of revenue recognition? When do you recognize revenue? Usually, it is at the point on the date of sale or at the date of delivery. Another type of transaction that results in revenue is rendering services. For example, like a law firm or CPA firm, you provide services and that results in revenue. Now, what is the timing of revenue recognition? Usually when services are performed or when they are available. And the third component is permitting use of an asset. For example, you rent an apartment to a tenant, that results in a rent revenue. Now, timing of revenue recognition, as time passes, when the month ends, the tenant is entitled to, or the tenant is obligated to pay you. Then you have earned the revenue. And the fourth type of transaction is really not, that is, we call it a sale of asset other than inventory. So that's a situation whereby Walmart decided to sell some of the computers that they use in the accounting department because they are pretty old. When they sell those computers, they sell those computers either for gain or loss when they sell the computers. But those computers are not part of their normal inventory. So therefore, it is really not revenue in the street sense of the word because selling those computers does not relate to the main reason why they are in business. Now, moving along, let's take a look at the departures from the sales basis. We said here that any recognition of revenue is appropriate if there's a high degree of certainty about the amount of revenue earned. In other words, if there is no issue in terms of how much revenue that we earn, of course, we have already provided the services, we recognize the revenue right away. However, there are some situations whereby revenue recognition has to be delayed because of these two factors. There is a high degree of uncertainty concerning the amount of revenue or cost is sufficiently high, or the sale does not represent substantial completion of the earnings process. In other words, you haven't really done the job substantially, and in terms of how much you are going to earn in revenue, is really not clearly defined or not clearly determinable. So in such circumstances, or in those circumstances, we delay revenue recognition. Now, moving along, let's take a look at the revenue recognition alternatives. Now, number one, at the point of sale. That is the general rule. More often than not, in most instances, revenue are recognized at the point of sale. For example, when you perform services or when you deliver goods or sell goods or product to the customer. That is the general rule. However, we have some situations whereby we deal with revenue recognition issues before delivery. So we have three components here: before production, during production, and completion of production. So here we are recognizing revenue even before we complete the job, and we also recognize revenue during production and we ultimately will recognize some of the revenue at completion of production. So we are going to talk about those examples eventually. Then after delivery, many revenue is recognized after we have actually delivered the product or actually performed the services or as cash is collected. So we are going to zero in on some of those issues as time progresses. Moving along, let's take a look at the second objective, and that is we are going to talk about accounting issues for revenue recognitions at the point of sale. Now, FASB concept number 5 said that companies usually meet the two conditions that we talk about for recognizing revenue by the time they deliver products or render services to customers. Now, the issues that make the recognition a little bit complex are as follows. More often than not, like we said, revenue recognition is very straightforward. You sell goods to customers, you recognize revenue, or you perform services. Here are some, like I said, some issues that make the recognition a little challenging. Number one, sales with discount, sales with right of return, sales with payback, bill and hold, sales, principal agent relationship, trade loading and channel stuffing, multiple deliverable arrangement. So we are going to talk about all of these in details. Now, the first one is sales with discounts. So this is the first example of revenue recognition at point of sale. Here are the accounting rules. Trade discounts or volume rebates should reduce the consideration received and reduce revenue earned. Meaning the discount that you give to the customer will reduce the potential amount that you are going to receive. Number 2, if payment is delayed, seller should input an interest rate for the difference between the cash or cash equivalent price and the deferred amount. What are we talking about here? You ask the customer to pay you in 2 years from now. Now, if the customer is paying you $10,000 2 years from now, in actuality, there is an interest component in that $10,000. So therefore, the $10,000 is not 100% revenue. Interest revenue is also part of the mix. Now, let's take a look at an example of sales with discount. Now, here are the facts as an example. X company has an arrangement with its customer that it will provide a 3% volume discount to its customers if they purchase at least 2 million of its products during the calendar year. On March 31st, 2014, X has made sales of $700,000 to A. In the previous 2 years, X sold over 3 million to A in the period April 1st to December 31st. So X made the following entry on March 31st. In other words, S is going to recognize or account for the revenue as follows. Accounts receivable is debited for $679,000 and sales revenue is credited for $679,000. That is 97% of $700,000, or 3% of $700,000 minus $700,000 will give you $679,000. So the customer or the client, the company recognized revenue accordingly. So that will do it for the first part of chapter 8 presentation.